Hey everyone, Ricardo here. Welcome back to another episode of Paragon Perspectives, The Long Watch. Over the summer, the mood in the stock market has been driven more by strong corporate earnings and continued enthusiasm around the AI build-out than by things like Iran and oil prices. The rally has also broadened beyond just a handful of chip companies. Smaller companies, financials, industrials, and other parts of the market have joined the party too. And naturally, when stocks are going up and the stories behind them sound more and more exciting, it becomes a lot easier to convince ourselves that almost any price is reasonable. That's usually when we need to be a little bit more careful. You guys know I like individual stocks. One of the reasons is that I think it's easier to understand what you actually own. When you buy a stock, you're not just buying a ticker symbol that moves up and down on the screen. You're buying a small ownership interest in a real business. That business sells products or services, earns products, generates cash, reinvests some of that cash, and hopefully becomes more valuable over time. But simply finding a great business isn't enough. We also have to figure out what that business is worth. Here's the simple version. Let's say there's a company called Widget Inc. Widget makes, whatever widgets do. Apparently they're profitable. If a widget is expected to earn $5 per share over the next year, and investors are willing to pay 20 times those earnings, the stock would be worth about $100 per share. Simple enough, right? That comes down to expectations. Investors are generally willing to pay more for a company if they can grow faster, if the business is high quality, if the balance sheet is strong, and if management is good at reinvesting capital for future growth. And this is where things get interesting. At some point, the question stops being, is this a good company, and becomes, how much of that good news is already priced in? Take Tesla as an example. It is recently traded at an extremely high multiple of expected earnings. At a current valuation of roughly 197 times earnings, investors are effectively paying $197 for every $1 of annual profit the company is expected to generate. If those earnings never grow, it would theoretically take 197 years of earnings to equal the price investors are paying today. Now, obviously, nobody's buying Tesla at that valuation expects earnings to stay flat. Quite the opposite. The price reflects very high expectations for future growth. And that's the real lesson. The more you pay for a company today, the more that company has to deliver tomorrow. Which brings us to AI. We're living through a once-in-a-generation period of investment in technology that may fundamentally change how we live and work. And companies are spending enormous amounts of money trying to build that future. When that much capital pours into one objective, bottlenecks can form. Certain components and services become scarce. The companies supplying them can experience explosive growth. Earnings go up, stock prices go up, and investors get very excited. Sometimes a little too excited. And that's where a great company can become a bad investment. Cisco is probably one of the best examples. In the late 1990s, Cisco was one of the best companies in the world. It was growing fast, it was highly profitable, and selling the networking equipment that made the internet possible. Investors weren't wrong about the importance of the internet, and they weren't wrong about Cisco being a great business. Where they ran into trouble was the price they were willing to pay for it. As enthusiasm around the internet grew, Cisco's stock price rose much faster than the underlying earnings of the company. Investors were paying for years and years of extraordinary growth that they assumed would continue far into the future. And when expectations get high enough, being a good company is no longer enough. The company has to be almost perfect. Earnings have to beat expectations. Profit margins have to stay strong. And competitors have to stay away, and a lot of assumptions have to play out pretty close to plan. Here's the part I really want you to remember. In the 10 years after 2001, Cisco's revenues grew by 75%, and its net income grew by 209%. Pretty nice, right? Except the stock price still lost about 46% of its value, falling from roughly $38 to $20 per share. The business did quite well. The investment did not. So why am I telling you all of this? Because this is one of the most exciting investment environments I can remember. There are some extraordinary companies building extraordinary things, and some of them may turn out to be tremendous long-term investments. But excitement and valuation are two different things. Our job as investors isn't simply to identify which companies may benefit from AI. Our job is to figure out how much of that future success is already reflected in the prices we're being asked to pay for today. And there's one final part of all this that I think is just as important. Sometimes discipline means passing on a great company because the price just doesn't make sense. Other times discipline means owning a good company through a difficult period because the business remains healthy and a long-term thesis hasn't changed. Those two decisions may look very different, but they come from essentially the same place. Understanding what we own, understanding what we think it's worth, and not allowing excitement or fear to make decisions for us. Sometimes the smartest thing we can do is buy. Sometimes it's to sell. And many times, after doing all of the work, the best decision is to do absolutely nothing. If you have any questions, please don't hesitate to reach out to us. Until next time on the Paragon Perspectives, The Long Watch.